Is the stock market going to crash if the housing market crashes in 2024? Now there's a question that's been itching at the back of our minds. The intricate dance of the housing and stock markets is not one easily understood, yet it's a dance that affects us all. In this video we're going to unravel this complex relationship, exploring the potential impacts of a housing market crash on the stock market. So, are you ready to take a deep dive into this economic puzzle? Stay tuned as we delve into the intricate relationship between the housing market and the stock market. To understand the potential impact, we first need to comprehend the essence of the stock market. Picture the stock market as a grand bazaar, bustling with activity. At its core, it's a marketplace where buyers and sellers trade shares, pieces of ownership in a company. These shares represent a claim on part of the company's assets and earnings. The more shares you own, the larger the part of the company you control. Now, why does the stock market exist? It's not just to make some folks extraordinarily wealthy, although that can be a side effect. The primary purpose of the stock market is to provide a way for companies to raise money. When a company sells shares, it's essentially selling a piece of itself in exchange for cash. This cash can then be used to fund new projects, fuel growth, or pay off debts. The stock market also plays a vital role in the economy. It's like a barometer, measuring the economic health of a nation. If the stock market is doing well, it usually means businesses are thriving, unemployment is low, and the economy is strong. Conversely, a struggling stock market often signals economic distress. It's important to note that the stock market is influenced by a multitude of factors, both domestic and global. It responds to changes in political climate, economic indicators, corporate earnings, and even societal trends. It's this complex interplay of factors that makes predicting stock market movements such a challenging task. Furthermore, the stock market's influence extends beyond the economy. It affects the wealth of individuals and institutions, shapes retirement savings, and even impacts our daily lives. Think about it. When the stock market is up, people feel wealthier and tend to spend more. This in turn drives economic growth and creates a positive feedback loop. In the grand scheme of things, the stock market is a critical component of the financial ecosystem. It's a complex, dynamic entity that reflects the collective optimism and pessimism of investors around the world. Now that we've grasped the stock market, let's move to its counterpart, the housing market. The housing market, often overlooked, plays a crucial role in our economy. It's an intricate web of transactions that involves buying, selling, and renting properties. This bustling market is a cornerstone of economic activity, influencing both personal wealth and the broader financial landscape. Let's break it down. Imagine the housing market as a large-scale game of Monopoly. It's a marketplace where properties are bought, sold, and rented, with prices determined by supply and demand. When demand outstrips supply, prices rise. Conversely, when supply exceeds demand, prices fall. But it's not just about buying and selling houses. The housing market also includes a myriad of related industries, such as construction, real estate services, and home improvement businesses. These sectors contribute significantly to economic growth, providing jobs and stimulating spending. Now, how does the housing market function? Well, it's influenced by a variety of factors. Economic health, interest rates, and demographic trends all play a part. When the economy is strong, people have more money to invest in real estate. Low interest rates make borrowing cheaper, encouraging more people to buy homes. Demographic trends such as population growth or urbanization can also drive demand for housing. Yet, the housing market can be volatile. It's susceptible to booms and busts, periods of rapid price increases followed by sharp declines. This volatility can have far-reaching effects on the economy. A booming housing market can drive economic growth, while a bust can trigger a recession. Remember the Great Recession of 2008? That was largely caused by a collapse in the housing market. So, what's the relationship between the housing market and the overall economy? It's symbiotic. The health of the economy influences the housing market, and vice versa. A robust housing market can boost the economy by stimulating spending and creating jobs. On the flip side, a downturn in the housing market can drag the economy into a recession. With a grasp on both the stock and housing markets, we can now explore their relationship. Understanding this dynamic is key to predicting potential impacts on the stock market, especially in the event of a housing market crash. Let's dive into that next. The stock market and the housing market, seemingly disparate, are more intertwined than you might think. To appreciate this connection, let's consider the big picture. The stock market, a barometer of economic health, is sensitive to a multitude of factors, including consumer sentiment, corporate earnings, and yes, the housing market. On the other hand, the housing market is a significant component of the economy. It's not just about buying and selling homes. It's about jobs in construction, real estate services, and home furnishings. When people buy homes, they also spend money on appliances, furniture, and renovations. This spending stimulates the economy and can lead to increased corporate earnings, which in turn can boost stock prices. But the relationship is not just one way. The stock market also influences the housing market. When the stock market is doing well, people feel wealthier. This increased wealth effect can lead to more demand for houses, pushing up house prices. Moreover, both markets are affected by interest rates. When interest rates are low, borrowing is cheaper. This can encourage people to take out mortgages and buy homes, driving up demand in the housing market. At the same time, low interest rates can also encourage investment in stocks, as the potential returns can be higher compared to other forms of investment. So you see, the stock market and the housing market are like two dancers in an economic ballet, each responding to the movements of the other. A dip or rise in one can set off a chain of reactions in the other. However, it's important to note that this interconnection doesn't necessarily mean that a crash in one will cause a crash in the other. There are many other factors at play, and the relationship between the two markets is complex. This connection leads us to our next question. What happens if the housing market crashes? Scene script. Picture this. It's 2024, and the housing market is crashing. What's the fate of the stock market? Let's step into this scenario for a moment. The housing market is a significant component of our economy. When it takes a nosedive, the ripple effects can be felt far and wide. But how exactly does it impact the stock market? Let's take a look at some potential outcomes based on historical trends and economic theories. Firstly, when the housing market crashes, many people lose a considerable chunk of their wealth, resulting in less spending. This decreased consumer spending can lead to lower corporate profits, which in turn could cause stock prices to fall. This is the direct impact theory. But the story doesn't end there. A housing market crash can also lead to a banking crisis, as we saw in the financial crisis of 2008. Banks and financial institutions, which heavily invested in the housing market, may find themselves in deep water when the market crashes, leading to a financial crisis that could significantly hurt the stock market. Additionally, the housing market crash could lead to a recession. When confidence in the economy is shaken, it often leads to a domino effect. Businesses may cut back on investments, consumers may tighten their belts, and these combined actions can result in a slowdown of the economy, hence a recession. During a recession, the stock market usually doesn't fare well. However, it's also important to remember that the stock market is not entirely at the mercy of the housing market. There are numerous other factors at play, including corporate earnings, interest rates, government policies, and global economic trends. So, a housing market crash does not necessarily guarantee a stock market crash. While this is a hypothetical situation, it's crucial to understand these dynamics to make informed decisions. By understanding these potential scenarios, we can be better prepared for whatever the future holds. After all, it's always better to be prepared than to be caught off guard. So, will the stock market crash if the housing market does in 2024? The answer is not as straightforward as we might desire. As we've navigated through this topic, we've uncovered the intricate and complex relationship between the housing market and the stock market. Remember, the stock market is a reflection of investor sentiment and the health of corporations, while the housing market mirrors the state of the economy and consumer financial health. Their interdependence means a significant change in one can send ripples through the other. If the housing market were to crash in 2024, it could impact the stock market. A housing market crash can lead to decreased consumer spending, which in turn could cause corporate profits to decline, potentially leading to a stock market downturn. However, it's crucial to note that numerous factors can influence these markets. It's not a simple cause and effect relationship. Economic policies, global events, and even investor psychology all have roles to play. So, to reiterate, while there's a possibility that a housing market crash could lead to a stock market crash, it's not a guaranteed outcome. There are just too many variables at play. While we can't predict the future, understanding these market dynamics can certainly help you make more informed investment decisions. So keep learning, stay informed, and remember, the best investment you can make is in your knowledge.